Hello everyone, and welcome back to the channel. If you have been following this series, we have already covered what an index fund is, how it compares to ETFs, and why most beginners should strongly consider investing in them. Today, in video 4, we are going to get very practical. I will walk you through exactly how to buy your first index fund or ETF, step by step. This video will be longer than the previous ones because I want to make sure every beginner can follow along without getting stuck at any point. We will cover choosing a brokerage, opening an account, funding it, searching for the right fund, placing your first order, and some important things to watch out for. As always, this is for educational purposes only and is not financial advice. Please do your own research and consider your personal financial situation before investing. Let's begin with the very first step. Step 1. Choose a brokerage account. To buy index funds or ETFs, you need a brokerage account. This is basically an account that allows you to buy and sell investments. There are many brokerages available, and the good news is that most of them now have very low or zero commission fees for buying ETFs. Some popular and beginner-friendly brokerages in 2026 include Vanguard, very good if you want to buy their own low-cost index funds and ETFs. Fidelity, Charles Schwab, Interactive Brokers, Robinhood, easier interface but fewer advanced tools. Webull, and many others depending on your country. When choosing a brokerage, here are some important things to consider. Trading fees. Most are now zero for stocks and ETFs. Expense ratios of the funds they offer. Minimum deposit required to open an account. Ease of use, especially important for beginners. Customer service quality. Tools for research and automatic investing. Tax reporting features. For most beginners in the United States, Vanguard, Fidelity, and Charles Schwab are often recommended because they have excellent low-cost index funds and ETFs, good platforms, and strong customer support. If you are outside the United States, you will need to check what brokerages are available in your country and whether they offer access to popular ETFs like VOO, VTI, or VXUS. Step 2. Open your brokerage account. Once you have chosen a brokerage, the next step is to open an account. This process is usually done online and takes between 10 to 30 minutes. You will typically need to provide personal information, name, date of birth, address, contact details, social security number or tax identification number, employment information, financial information, income, net worth, investment experience, bank account details for funding. Most brokerages will ask you what type of account you want to open. Common options include individual brokerage account, taxable account, joint account, retirement accounts such as IRA or Roth IRA, trust account. For beginners, starting with a simple individual brokerage account or a Roth IRA, if you qualify, is often a good choice. If your goal is long-term investing for retirement, using a tax-advantaged account like an IRA can be very beneficial. After submitting your application, the brokerage will usually verify your identity. This can take anywhere from a few minutes to a couple of days. Once approved, you will have access to your new account. Step 3. Fund your account. After your account is approved, you need to add money to it before you can buy investments. Most brokerages allow you to link your bank account and transfer money electronically. Common ways to fund your account. Electronic bank transfer, ACH. Usually free, but takes 1 to 5 business days. Wire transfer. Faster, but may have fees. Check deposit. Less common now. transferring investments from another brokerage. Many brokerages now also allow you to set up recurring automatic transfers. For example, you can set it up so that $200 or $500 is automatically transferred from your bank account to your brokerage account every month. This is a great way to build the habit of consistent investing. When funding your account for the first time, start with an amount you are comfortable with. There is no need to invest a large sum immediately. Many successful investors started small and increased their contributions over time. Step 4. Decide what to buy. Now comes one of the most important decisions. Which index fund or ETF should you buy? For most beginners, the simplest and most effective approach is to start with one or two broad, low-cost funds. Here are some popular recommendations. If you want exposure to the U.S. stock market, VOO, Vanguard S&P 500 ETF, or VTI, Vanguard Total Stock Market ETF. If you want international exposure, VXUS or VT. If you want a simple one-fund solution, VT, Vanguard Total World Stock ETF, gives you both U.S. and international stocks in one fund. Many financial experts recommend a simple portfolio such as 70 to 80% in a U.S. total stock market fund, like VTI, 20 to 30% in an international stock fund, like VXUS, or even simpler, 100% in VT if you want maximum simplicity. When choosing funds, pay attention to expense ratio, lower is better, assets under management. Larger funds are usually more liquid. Tracking error, how closely the fund follows its index. Dividend yield, if you care about income. You do not need to overcomplicate this at the beginning. Starting with one or two solid, low-cost, broad market funds is much better than trying to build a complicated portfolio with many different funds. Step 5. Place your first order. Once you have decided which fund to buy, it is time to place your order. In your brokerage account, go to the search bar and type the ticker symbol of the ETF or index fund you want. For example, type VOO. After selecting the fund, you will see options such as buy order type, market order or limit order, quantity or dollar amount. For beginners, the easiest way is often to use a market order and invest a specific dollar amount. For example, buy $500 worth of VOO. Some brokerages also allow you to buy fractional shares, which means you can invest any amount you want, even if it is less than the price of one full share. After reviewing your order, click to submit it. Your order will usually be executed within seconds if you are using a market order during market hours. Congratulations! You have just bought your first index fund or ETF. Step 6. Set up automatic investing. Optional but recommended. One of the best things you can do after making your first purchase is to set up automatic investing. This means scheduling regular investments, for example, every week or every month, so that money is automatically invested without you having to remember each time. Automatic investing helps you build the habit of consistent investing. Take advantage of dollar cost averaging, buying more shares when prices are low and fewer when prices are high. Remove emotion from the process. Most brokerages make it very easy to set this up. You can usually choose the amount, frequency, and which funds to invest in. Important things to watch out for. Even though buying index funds and ETFs is relatively simple, there are still some common mistakes beginners should avoid. Buying during market hours without understanding that prices fluctuate. Investing money you might need in the short term. Trying to time the market. waiting for the perfect time to invest. Ignoring fees. Always check expense ratios. Not diversifying enough. Putting everything into one single stock or sector. Panic selling when the market drops. Another important point is taxes. If you are investing in a taxable account, be aware that selling investments can trigger capital gains taxes. This is another reason why many people prefer to do most of their long-term investing inside retirement accounts, like IRAs. How to monitor your investments. After buying, you do not need to check your investments every day. In fact, checking too often can lead to emotional decisions. Many successful long-term investors only review their portfolio a few times per year. When you do review, look at overall performance compared to your goals. Whether your asset allocation still matches your risk tolerance. Any major changes in your personal financial situation. You do not need to make changes just because the market went up or down in the short term. Final thoughts. Buying your first index fund or ETF is a big and important step. It does not have to be perfect. Many people overthink their first investment and end up delaying for months or even years. The most important thing is to start. Once you have made your first purchase and set up automatic investing, you are already ahead of most people. From there, the key is to stay consistent, keep learning, and remain patient. In the next videos, we will cover more advanced topics such as building a complete portfolio, understanding asset allocation, rebalancing, and common mistakes that can hurt your long-term returns. If this step-by-step guide has been helpful, please give the video a like and subscribe to the channel. It really motivates us to keep creating detailed content like this. Leave a comment below and let me know. Have you already opened a brokerage account? Or are you still deciding which one to choose? What questions do you still have about buying your first index fund or ETF? Thank you very much for watching all the way through. I will see you in the next video.